Here we're discussing the bigger picture, but always very happy to go deep into individual countries, individual issues, and get a lot more specific as well. So with that, let me kick this off with just a couple of key takeaways on what we expect from 2024. First, we call this webinar recovery. We still think we're talking about a recovery, but relative to last year or 2023, we will see only a small acceleration in demand. This year already surprised on the upside. Next year is unlikely to be a significant bounce back year, but we do see some reasons for optimism. That is not necessarily the case for a major market like China, which will remain a big open question for a lot of companies, and its outlook remains highly uncertain. We'll go deeper into that in a little bit, but that will be one area of risk from a growth perspective to monitor. On the plus side, we do expect that input costs are going to remain low, certainly lower than what we saw in 2022. That will support a easing of inflation and the general movement towards more normal levels of inflation, if you will, and that will also allow for some easing in terms of credit costs. But peak inflation is not exactly the same as peak price sensitivity. So we will be having a conversation about pricing a little later today and some benchmarking on it, but we think there's still more price sensitivity ahead of us, which is going to call for a slightly different approach in terms of growth, because recently we've seen companies being able to do a lot on revenue growth through price actions, even if volumes were contracting. It will be a very different environment in 2024. And so the ability to support growth, even if demand is sluggish through pricing, will be much harder. And then when we think about the public sector, we don't expect any dramatic issues there in terms of debt sustainability across major markets, but governments are increasingly under pressure to fund gaps in terms of their deficits and to also get their debt levels under control. And so we will be seeing maybe some early action in terms of tax revenue collection and maybe even questions about taxation overall starting to pop up as we enter 2024. Now, with that said, I did promise some benchmarking, and we're about to start that process now. And so all of you on the line, we're asking you a very quick question around which aspect of your 2024 plan you feel most uncertain about. Again, these are anonymized, and we will see the results as soon as we have enough respondents. I will show them to you right away. So take a second to answer, and then we'll look at what the group is saying. Okay. I'm about to close the poll. Let's see what the results are saying about what people are prioritizing. Okay. So demand assumptions, still big open question, actually very understandable because of the questions around growth that we're about to explore. And then we were hoping to prime you a little bit on pricing, and it looks like we were able to. So we will come back to that pricing question with a little bit more benchmarking coming forward. Great. So Anton, take us into the discussion about 24. What do we think about macro demand drivers? Is this actually going to be an improving macro outlook, and what should companies put into their plans?
Yes. Hello, everyone. A lot to cover today, so I'll try and be efficient. But of course, if you have any questions, feel free to drop them in the chat, and we'll be more than happy to answer. So when we look at the 2024 outlook, these are the assumptions that we base our analysis on, that we operate on. In terms of growth, as Martino alluded to, we expect a slightly improving growth outlook at the headline level, the global GDP level. However, that doesn't tell the whole story, because there are many underlying dynamics with very different positive or negative outlooks. And conceptually, how we look at this is that different pockets of the economy, different geographies will perform very differently. And so some will do well, some will do badly, and in effect offset each other and yield these stable global growth figures that maybe don't quite tell the whole story. This is the idea of the rolling slowdowns, the rolling recessions, where, again, these different parts offset each other. Again, China's an open question. We're not entirely sure what the outlook is. There is a lot of uncertainty there, and that could be a real driver of either growth or lack thereof in 2024. On the inflation side of things, everything seems to have improved. We have seen the back of the big inflationary shock of 2021 and 2022, but there are still some uncertainties, some things which could yield to maybe stickier inflation than we expected, notably food, but again, we'll get into that. That then informs interest rate policy around the world. We expect to have seen peak interest rates and the start of a monetary loosening cycle in 2024, different paces, obviously, depending on the geographies, but we think that interest rates will begin to fall in 2024, maybe not quite to the levels that we have been used to in the last 10 years. And of course, there's the ever-looming question of geopolitical risk. The war in Ukraine is the obvious one, but there is also tensions around between the US and China around the Taiwan question, and 2024 is, amongst other elections, a election year in the US, and so obviously that will be a big topic next year. Here you can see some of our forecasts for 2024. So these are growth figures, so 2.9% year-on-year growth for 2023 is what we expect, and then 3.1. So again, nothing dramatic. We'll cover the big economies, the US, Europe, and China in a bit more detail. But here I do want to highlight some interesting countries with some positive, less positive dynamics. Mexico is one that we expect to continue to perform well. Part of that is strong consumer spending, thanks to remittances from the US, which are reaching historic highs. A lot of manufacturing reshoring and a lot of dynamics pointing that way. We also look at India as one of the star students, will continue to be. There is a very robust domestic demand in India. It is a bit less exposed to the global economy, so maybe a bit more immune to some of the uncertain patterns going on there, and also some very strong government investment in infrastructure. Saudi Arabia, the GCC, also attracting a lot of attention, a lot of investment, maybe a slightly lower growth figure, but coming from a very high base effect. A lot of public sector projects, a lot of strong private sector growth. So a mixed bag, but we do want to highlight some of these markets, which we think we want to draw some attention to. Looking at the US is one of the countries that has surprised us very positively this year. US growth has been very resilient in 2023. Part of that, well, most of that has come from consumer spending, which has remained very strong and which continues to be resilient, even despite 18 months of very high inflation. Now, this is coming off of a very high level of personal savings, a very strong labor market, which has helped fuel the American consumer spending. We do expect that to slow. Savings have been depleted. We expect a very slight uptick in unemployment. We're also seeing things such as the resumption of student loan repayments, which are going to weigh on consumer spending. So if that comes down, given the weight of that in American GDP, that will also drag American GDP down. We're seeing slower investment, except for very specific pockets of the US economy, notably warehouse, factory building. That's directly attributable to the IRA, the CHIPS Act. So a lot of investment in electric vehicles, semiconductors, clean energy, which is helping support some parts of the investment side of the story. But again, it's still a relatively subdued outlook there. So we expect a slowdown in the US. We don't expect a deep recession, nothing of the sort, but we don't think that the US will continue to grow at the pace that it has grown in early 2023. In Europe, we will continue to see a diverging outlook between Northern Europe, Eastern Europe, and Southern Europe. So North and Eastern Europe continue to suffer from structurally high input costs. This is obviously due to the energy situation, very sluggish manufacturing activity, which we don't expect to improve in the very near term. Whereas in the South, Spain, Italy, they're benefiting a bit more from the tourism rebound, lower inflation, which was helping consumer spending. So we expect this to continue into 2024. One story that we're going to see in a lot of Europe, particularly Eastern Europe, is fiscal consolidation. A lot of countries do plan on reining back some of the support that they gave out in the last 18 years. We're also going to see interest rate cuts broadly across Europe, which should support some economic activity. But overall, it will be a relatively slow year in terms of in Europe, if you compare with historical standards.
Hi, my name is Krista Reganey, and I'm the Marketing Director here at FrontierView. I'd like to thank you for watching a segment of this webinar. If you'd like access to the full video and our latest insights, data, and research, sign up for a free trial with us today. Simply scan the QR code on the screen.